When it comes to the home buying process, a mistake that a lot of individuals make is they look in the newspaper, they look online, or they go word of mouth and they try to go with the lowest interest rate that they're quoted. This is not often how it works out in the end. Interest rates will change, and you need to know the answers to 6 questions that may affect your interest rate. The first thing you need to know is your credit score. Your credit score will be determined from the 3 major credit reporting agencies: Experian, TransUnion, and Equifax. We're going to take the middle score of the 3. So if your scores are 800, 759, and 725, we're going to use the 759 when determining your credit score for qualifying purposes. At the vast majority of mortgage companies, your credit score will affect your interest rate and ability to secure a home loan. Question number 2, what is your down payment? The down payment needs to be determined not only in dollar amount, but in percentage. So, for example, if you have a $100,000 down payment and you're buying a home for $500,000, you're going to have a 20% down payment. If you buy a $550,000 property with the same $100,000 down payment, you're going to be above an 80% loan to value, and you will need to obtain private mortgage insurance, which is going to affect the affordability of your home. The third thing you need to know is the property type. The property type will affect your interest rate at most lending institutions. Are you buying a condominium, a single-family home, or a multifamily home? All 3 may have different rate criteria at most lending institutions. The fourth question is occupancy. Occupancy will also affect your interest rate at most lending institutions, including ours. Is it owner-occupied? Is it a second home? Or is it an investment property? Question number 5. How many days until closing? The closing date will also potentially affect your interest rate. Are you closing in 30 days, 60 days, 90 days, or 120 days? The longer your closing is out, the greater the likelihood that your interest rate will be increased, because the bank has to hedge against rising interest rates for a longer period of time. And lastly, question number 6. What mortgage product are you going to choose? The product type will normally be a fixed rate or an adjustable rate mortgage. One of the common mistakes here is people think they can qualify for a larger mortgage if they start with a lower interest rate on an adjustable rate mortgage, and that is not always the case. Today's rates I'm quoting are for example purposes only. Obviously, when you view the video, rates will be different at that time. If you took a 4% interest rate on a fixed rate today, you'd be qualified at 4%. However, if you're looking at for a 3-year adjustable and you took a 3% interest rate thinking you qualify for more mortgage money, that 3% will be qualified at 5%, which is 2% above the start rate based on your first potential change date. So you're actually not going to qualify for more money because you'll be qualifying at 5% versus 4%. Now that you know the answers to the 6 questions, the next thing a lender is going to look at is your ability to obtain a home mortgage. We're going to look at the 3 C's: credit, capacity, and collateral. We will first start with evaluating your credit. We will look at your monthly payments, such as student loans, car loans, current mortgage payments, credit card payments, and more. It's important that you do not have any late payments, as timely payments are critical to increasing your credit score. When you come in to meet with us, we'll suggest ways to improve and increase your home buying power. Next, we'll look at your capacity, which includes your down payment ability and your income. We'll start with your income. If you're a salaried employee, it's a relatively straightforward process. However, if you receive commissions, bonuses, or self-employed, we'll need to compare your tax returns. We will work with you and analyze your tax returns and income information to determine what you can best afford. Third is collateral. This is the type of property and down payment you are considering. We will look at how your down payment affects your interest rate and your monthly payment. For example, is it a single-family home with 20% down or a condominium with 5% down? Is it owner-occupied or is it an investment property? Lastly, there is a 4th C that we consider at National Grand Bank. Being a local bank, we know our customers. We know who walks through our doors, and we know their families. If it's a judgment decision, often we'll look at character, and we'll try to make the correct decision for that person and the bank. Now that we've evaluated the now 4 C's, we'll look at this process and vet out what you can afford towards your monthly payment. Generally speaking, you want to keep your monthly payment for your home between 28 and 33% of your qualifying income. Including debts, we'll be adding back car loans, student loans, credit card debt, etc. We like to keep your proposed housing payment along with your consumer debt under 40% of your qualifying monthly income. Here's an example of how a borrower increased their buying power. Example, they had an automobile payment that was $600 a month and they only have 11 more payments on the loan. I suggested paying that loan off for $6,600. By doing this, we freed up $600 more in buying power towards their home mortgage, which provided them with another $100,000 in mortgage buying power. Analyzing debt can make a big difference in the size of a mortgage someone can obtain. We will analyze this for you and try to do what's best for you. Our goal is to make sure you are comfortable with your mortgage payment that you are pre-qualified for. Now let's use an example of how the 6 questions that I talked about earlier can affect your interest rate. The example I'm going to use is you have a 20% down payment, your middle FICO score is 700, you're considering buying a condominium and it's going to be owner-occupied and you're going to close within 60 days and you want a fixed rate mortgage. For example purposes only, you found a rate online at 4% with 0 points on a 30-year fixed. The vast majority of rate quotes online assume a credit score of 740 or higher, single-family, owner-occupied residence with a minimum of 20 to sometimes 40% down. This is because most lenders will sell your loan on the secondary mortgage market, most likely either Fannie Mae or Freddie Mac. These agencies use risk-based pricing models. In this example, the rate of 4% with 0 points increases to 4.375 with 0 points because of the credit score, down payment, and property type. At National Grand Bank, our quoted rate of 4% with 0 points would stay at 4% with 0 points because we are holding the loan in our own portfolio. As you can see, all rate quotes are not created equal. Make an appointment to come in and visit our mortgage department for a face-to-face meeting, or we can talk over the phone or via the internet. We'll look at your personal example and tailor-make a mortgage that's best for you. Please stay tuned for our next video in this series, Understanding the Pre-Qualification and Application for a Mortgage Process.